Imagine landing in the United States, getting your first paycheck, and expecting to manage your money with a single tap. You ask for a recommendation, and within a week, your phone is cluttered with nearly a dozen different financial applications. The American financial ecosystem relies on fragmentation. Instead of one monolithic program, users construct a network of specialized tools, each engineered to solve a distinct problem. Navigating this decentralized mosaic is the baseline requirement for modern financial survival. When you start a corporate job in a city like New York, your employer needs a reliable destination for your salary. By law and structural necessity, those funds land in a traditional legacy bank account. Institutions like Chase or Bank of America provide the foundational utilities. They act as the central hub for receiving direct deposits, scanning physical checks, and routing utility bill payments. These legacy institutions offer massive scale and security. But that rigid infrastructure makes them slow and often expensive for daily microtransactions. Traditional banks provide the concrete foundation. Because they lack agility, they create a vacuum, forcing Americans to find faster tools for everyday spending. Neobanks step directly into that vacuum. These are financial institutions with zero physical branches, operating entirely inside your smartphone with no monthly maintenance fees. They attract younger users by offering highly responsive features, like releasing paychecks 2 days early and delivering real-time spending notifications. Yet, even neobanks hit a wall when it comes to social spending. Splitting a dinner bill becomes incredibly awkward when you have to ask a friend for their direct routing number. Peer-to-peer payment platforms strip away that friction. They allow users to transfer money using a phone number or username, making the exchange as instant as sending a text message. Physical commerce has seen a similar evolution. Digital wallets absorb your debit card, meaning you can check out at a store by simply tapping your phone against the terminal. This agile layer makes moving and spending money effortless. But keeping your funds highly liquid leaves them completely exposed to inflation, requiring a pivot to wealth generation. This diagram illustrates the macroeconomic threat to liquid cash. The static block shows idle money losing purchasing power over time, while the dynamic block grows through investment. Retail apps address this decay by democratizing access, allowing anyone to buy equities and micro-invest with spare dollars. As a person's financial life matures, perhaps they launch a startup, the requirements shift again. Mixing personal wealth with corporate operations creates an accounting disaster. Business banking applications are built for this heavy lifting. They process multi-employee payrolls, organize tax data, and manage incoming invoices from a single dashboard. Mastering personal wealth generation and business capital introduces a new vulnerability. With cash flowing across so many decentralized platforms, users quickly lose visibility over where their money is actually going. The universal consequence of a 10-app ecosystem is financial leakage. Small, recurring digital expenses easily slip under the radar. Budgeting apps serve as diagnostic tools. They pull data from every platform in your network to expose forgotten subscriptions and visualize exactly where every dollar is spent. A different kind of friction emerges when money needs to cross borders. Sending funds to family overseas via traditional bank wires typically involves high fees and days of waiting. Specialized international transfer apps bypass legacy wire systems entirely. They offer faster currency exchange at lower rates, acting as a crucial lifeline for immigrants managing international finances. Back at the retail level, massive point-of-sale purchases present a severe barrier, threatening to drain carefully managed cash reserves in an instant. This graphic illustrates buy now, pay later platforms. They eliminate upfront barriers by allowing buyers to divide a purchase into micro-installments. This provides flexibility, but carries high risk. If you miss a payment, those micro-installments quickly trigger cascading, high-interest debt. These advanced tools prove that no single platform has the architecture to plug budget leaks, cross borders, and manage algorithmic credit simultaneously. From this height, the individual apps on a smartphone screen reflect the broader architecture of how capital moves through a modern city. Americans use so many different banking apps because the U.S. financial landscape is built entirely upon these narrow, specialized niches. Each platform handles a specific task that the others weren't designed to support. While this fragmentation creates layers of complexity for the user to manage, it also ensures that every friction point, from international wires to splitting a dinner check, has a dedicated digital bypass. If you move to the US tomorrow, which of these specialized layers would you need to download first? Let us know in the comments. In our next video, we'll look at which specific providers in this mosaic are the most reliable for the coming year.